Hello and welcome to another episode of the M2M podcast. Today we're going to jump into the RBI's monetary policy announcement. They have dropped a bombshell of sorts by reducing the repo rate by 50 basis points, half percentage point. And that's not all. They have even reduced the CRR ratio by a full percentage point. Now, let's unpack this in terms of what are the implications for investors, businessmen, businesses, retired people for whom this is a very sensitive topic. And we, of course, have the always ebullient Manoj with us.
Quite a surprise, really. I recently went to a party and there was a buffet. But to my surprise, there was a live counter.
Okay.
And as if that was not enough, then we had three additional sweet counters. Now, that's precisely what RBI has done this time. While people were expecting that there would be a rate cut, it actually delivered more than what was expected, 50 basis points. And then out of the blue, they decided to cut CRR by 1 percentage point. So that is quite impactful from an economy perspective.
Yeah, so I was about to say, let's start with the headline numbers. You've already covered them. So why don't you just walk us through the just desserts that the RBI has served us on in the buffet this time?
So the first one, the cut in repo rate. See, what does it mean? It means that banks can borrow from RBI at a lower rate than they were able to earlier.
Yeah.
Now, in our country, interest rates are deregulated. They have been deregulated for quite some time. So banks are free to lend at whatever rate. But RBI sends a signal to these banks by saying that, look, I am cutting rates. So it is now your turn to pass on this benefit to the end borrower.
Right.
So what this translates into is all borrowers, home loan buyers, home loan borrowers, people who have taken car loans, corporates who have taken term loans, all those loans which nowadays everything is being structured variable way. Okay, so it's no longer a fixed rate.
Right.
So almost every loan will get repriced to a lower rate of interest, which means immediately a lot of saving for people like you and me and for corporates as well. So you will see that impact in terms of better bottom lines, as well as more spending because now you have got a little more money, which will again either get spent or invested. So therefore, this will significantly boost the economic activity.
Wonderful.
Now, to complement this, the other dessert is a CRR. Now, what is CRR? It is the amount of deposits that banks have to park with RBI. That means it's kind of blocked money. So banks have taken deposits, but they can't put it to use.
Right.
Now, by reducing CRR, RBI is saying, okay, I will allow you to keep more money. What is the bank going to do with that more money? It is obviously wanting to lend.
Right.
Now, if you've got more money to lend, again, it will translate to lower interest rates because you have got more supply of money.
Right.
So this will.
So yeah. So lot of action in one MPC meeting by RBI.
Yes.
And just to put this in context, the last time these rates were so low was in August 2022 when India was still reeling from the aftershock of the COVID. So interesting development. Now let's expand more on what does this mean to the average Indian, both borrowers and savers. What is the immediate impact?
So for borrowers, we already talked about it. Now, what is going to happen is every person who has borrowed money is going to go back to the bank and renegotiate.
Yeah.
Not the entire 50 basis point is going to be passed on because banks will have different sources from which they've raised money and some of that would be fixed.
Right.
But definitely you will see at least a 30 basis point reduction in the interest rates on various types of loans.
Right.
Okay, so this obviously is going to reduce EMIs, for example.
Right.
Okay, maybe an additional 1,500, 2,000 rupees will matter a lot to the middle class.
Right.
So added to the benefits that they have got by way of a very friendly budget, the amount of money, the disposable income is going up. Now it is the RBI fiscal monetary policy and fiscal policy are actually intact, uh, are in sync,
Right.
resulting in more money in the hands of the consumer.
So borrowers will benefit. Savers may have to look for other avenues for better returns, maybe equities, mutual funds.
Yes. So again, the signal from Reserve Bank of India is that don't bank on fixed or assured returns. If you see over the last 15, 20 years, the message is that you can't just park money and say that okay,
Right.
my life is set.
Right.
Okay, so there is going to be competition for funds,
Right.
and people have to look for
Better.
returns adjusted for risk.
So gold is anyway glittering these days.
Yes.
Yeah.
So, but again, just in case the savers are becoming very disillusioned, let me add that it's not going to be a very drastic reduction in deposit rates. As it is, as I said, there is competition for funds. So people are investing in mutual funds, are investing in direct equity, bonds, etc. So banks are facing this intensity of competition. So they can't just like that cut interest rates as they used to do earlier.
Right.
So it might mean to some extent a reduction in the net interest margin.
Right.
Okay, so that is something that we have to evaluate, look at bank. A bank like State Bank of India might want to, SBI doesn't care. It knows that its depositors will deposit with SBI irrespective of the rate of deposit. You've seen earlier that FD rates were 4%.
Right.
And still SBI deposits grew.
Right.
So, but then other private banks, other banks might have to fight it out with other banks.
Right.
So there will be implication on the banking sector. There will be implication on the financial services sector. Mutual funds money will come in.
Correct.
So, lot of dynamism, but
Absolutely.
overall the economic activity will increase.
Speaking of bonds, I mean, for our HNI client investors, we have always said that bonds might be a better, more tax efficient vehicle for investing as opposed to even debt funds. So that's a different topic for another day. So let's zoom out into the macro picture. What is RBI's reading of the economy right now? What do you make out of the whole series of events?
The recent policy announcement is a statement of confidence.
Mhm.
The RBI is stating in no unclear terms
Right.
that the Indian economy is going to continue to grow and all the factors are kind of aligning.
Right.
Sorry, Kainat.
The GDP estimates have been revised.
Yes. Inflation numbers are lower.
Yeah.
Above normal monsoon is being
So it's early this time. Yeah.
It's early and above normal projection. So that means we are going to have good rains.
Right.
Okay. And economic activity, as you said, GDP numbers have been revised. Of course, we need to be mindful. Q4 2025 should not be the basis because we had a very unusual Kumbh Mela,
Right.
144 year event, which kind of pushed the GDP growth. We may not have that kind, but still the numbers are positive, particularly given the gloomy scenario in the rest of the world.
Right.
India looks like a knight in shining armor.
I mean, inflation numbers were very encouraging. I mean, if
Yeah.
you take core inflation, for example, excluding food and fuel, it has dropped below 4% for the first time in 2 years. It's pretty much met whatever target the RBI had set for itself.
Yes, and RBI has always been conservative.
Yeah.
So it's not like RBI will go out of the way to project something
Correct.
and try to fix things, etc.
Correct.
So coming from RBI, a reduction in interest rate targets is definitely an indicator that inflation is going to be in control, which means longer period of lower interest rates.
So,
having said that, we also have to read into the statement that the stance has changed from accommodative to neutral. Means RBI is telling that I can't go on cutting interest rates.
Absolutely. Signaling a bottom.
They are kind of signaling a bottom, or bottom is very near. So if situation warrants, if they think that interest rates need to be brought down further, they will probably do it because it's a neutral stance.
Right.
But they're not going to go out of the way to accommodate a lower interest rate regime because we kind of reached the bottom.
So it's a good time to review those long-term bonds or debt funds that one has in, let's say, GSEC bonds or other bonds, because the NAV appreciation probably has been pretty good so far. So maybe a good time to look at long-term bonds which have, if already invested in, because they've already kind of run up quite a bit.
Typically, what happens if you are holding a high interest rate bond and the rates come down,
Right.
the bond value increases because it is more attractive than the
Fair point.
current. So bond values will go up, debt fund NAVs will go up,
Right.
and therefore it makes sense to continue to hold. Having said that, over a period of time, adjusted for the higher market value, the yields are going to be lower because interest rate is now lower. So it all kind of evens out over a longer period.
Very
of time.
long
So
term,
3
it
to
evens
5 year
out.
period.
Yeah.
You don't have to worry too much about the interest rate, but
Right.
yes, you benefit because the environment is more benign.
So all this sounds very rosy. Do you see any red flags?
I won't say red flags, but a word of caution. We've had an extraordinary Q4 FY25. We may not be having the same rates of growth in this quarter.
Yeah.
And typically, particularly monetary policy initiatives, you do not have control on where exactly the money will go. Now, just to take an extreme example to drive home the point, RBI has released more money into the market. Now, instead of this money going into productive channels, what if the entire money is soaked into buying a non-productive asset like gold?
Right.
Then the benefits that the economy is expected to get out of these moves will not happen.
Correct.
Okay. So it's a step in the right direction. It is, it's pointing towards a very favorable ecosystem.
Right.
But we need to continue to be watchful.
Right. So let's wrap this up. Keep it short and sweet. What is the final implication for our investors?
Okay, so the big message from RBI is that it is showing confidence in the Indian economy. So the macro picture looks very good. And as I said before, it is not coming out of some aggressive stance. It's coming from a conservative RBI.
Right.
So the big picture looks good. Corporate earnings will benefit due to lower interest rates. Spending will increase because of more disposable income, and therefore corporates are likely to benefit. So bottom line should go up, profitability going up.
Now, what about, let's say, equity investors and fixed income investors?
That is what I'm saying. So equity investors will look for increasing in their stock prices.
Right.
That will be driven out of valuations and profitability.
Correct.
Profitability is likely to benefit theoretically based on lower interest rates.
Right.
The positive ecosystem should push up the valuations.
Wonderful.
Because of positive approach, a positive outlook.
Right.
And therefore, you should see equity markets doing well. Bond markets, you will have an immediate uptick, but over a longer period of time, it all evens out. Bond markets are for safety and stability. That we'll continue to see. We're not seeing any immediate risks to defaults or any such thing. So overall, good situation to be in.
Awesome.
We can enjoy our desserts.
Excellent. I think with that, we'll close. Clearly, RBI is very comfortable about inflation and is also committed to supporting growth, which is good for equity investors in the long run anyways. So with that, we'll wind up and see you again in the next episode.